Welcome to the Retirement Wealth Podcast. We're so glad you're joining us today.
Absolutely. It's great to be here.
You know, one topic that often gets overlooked in retirement planning is estate planning. It can feel a bit overwhelming, but it's so important, right?
Definitely. A solid estate plan can provide peace of mind, not just for you, but for your loved ones as well.
Exactly. So in this episode, we'll be diving into an estate planning checklist for beginners. We'll cover the essential documents you need, common mistakes to avoid, and how you can make this process a lot smoother.
And we'll also talk about why it's never too early to start thinking about these things, even if retirement feels far off.
Yeah, it's all about being prepared and ensuring that your wishes are honored.
Right, so whether you're just starting to think about your estate plan or you've been meaning to get to it, we've got some valuable insights for you today.
And who doesn't want to feel more secure about their future, right?
Exactly. So let's jump right in.
First off, let's talk about the core documents you'll need for a solid estate plan. What's the first thing someone should consider, David?
So, Emily, when we talk about estate planning, it's not just about having a will, you know? It's really critical right now, especially with everything going on in the economy.
Absolutely, David. I mean, with inflation being what it is, people are really worried about their retirement savings lasting throughout their lifetime. It's like they need to ensure their money can keep up with rising costs.
Exactly. Let's say someone was planning to retire in the next few years. They might have saved a good nest egg, but if inflation keeps rising, that money doesn't stretch as far as it used to. I had a client recently, Jim, who thought he had enough saved, but with the current inflation rates, his purchasing power is significantly lower than he anticipated.
That's such a good point. And with market volatility, people are feeling the pressure. They might be hesitant to invest, thinking they'll just play it safe. But then the question becomes, how do they protect their assets while still allowing them to grow?
Right, and that's where estate planning comes into play. It's about not just protecting what you have, but also ensuring that your assets are distributed according to your wishes when the time comes. It's about legacy planning too.
Speaking of legacy, I think a lot of people overlook how important it is to have those conversations with family. Like, I know someone whose parents didn't have any estate planning in place. When they passed, it turned into a huge family dispute over the house. It was heartbreaking.
Oh, I've seen that too. A lack of communication can lead to so much stress and emotional turmoil during an already difficult time. But when families talk things through, it can really help. It's a chance to share values, expectations, and, what's important to each person.
And it's not just about the big stuff, right? It can be about personal items, memories. Those things can hold so much value.
Yes, those sentimental items often matter more than the financial assets. It's a reflection of your life and what's important to you. And when it comes to planning, people often neglect healthcare costs, which can be a huge part of retirement.
Oh, absolutely. I think many folks underestimate how much they'll need for healthcare. It seems like every year, medical expenses just keep climbing.
Exactly. I had a couple, Karen and Tom, who were planning their retirement. They had a solid financial plan, but they didn't account for their healthcare needs as they aged. Now they're in a situation where they have to adjust their lifestyle to accommodate those unexpected expenses.
That's a real wake-up call. And then there's Social Security. Changes are happening all the time. I mean, it's hard to keep up.
That's true. Many people aren't aware of how their benefits might change based on different factors, like their age or changes in legislation. It's important to stay informed about those changes and how they might impact your retirement planning.
So it sounds like there's a lot to think about right now. With all these economic trends, people need to focus on not just saving, but also being strategic about their withdrawals and tax implications.
Absolutely. Tax efficiency is huge. You want to make sure you're not giving away too much of your hard-earned money to taxes in retirement. I've seen retirees who didn't plan for their tax situation and ended up in a higher bracket than they expected, which really cuts into their income.
Wow, that's really eye-opening. So with all these factors at play, like inflation, market conditions, healthcare, and taxes, it's really crucial for people to have a comprehensive estate plan that takes all of this into account.
Right, and it's not just about the financial aspect either. There's an emotional side to achieving financial security in retirement. People want to feel secure and confident about their future, and that includes knowing their loved ones will be taken care of.
Yes! That peace of mind is invaluable. It's about having a plan that not only protects your assets, but also supports your family after you're gone.
And let's not forget about the importance of regularly updating those plans. Life changes, right? Whether it's a new grandchild, a change in health, or financial shifts, it's important to keep your estate plan current.
It seems like a continuous process, doesn't it? Like, you don't just set it and forget it.
Exactly. It's an ongoing conversation with yourself and your family. So as we move into discussing some core strategies, I really want listeners to think about the broader picture here.
Yeah, it's all interconnected, isn't it? The financial, emotional, and relational aspects of planning for the future.
Right. Let's dive into some actionable strategies that can help listeners navigate this complex landscape. So, Emily, when we think about the core strategies for estate planning, one of the first things that comes to mind is having a solid asset allocation.
Right. That's super important. Can you break down what asset allocation really means for someone who's just starting out?
Absolutely. Asset allocation is basically how you distribute your investments across different asset classes, like stocks, bonds, and cash. A common rule of thumb is the 70-30th portfolio, where you might have 70% in stocks for growth and 30% in bonds for stability.
That sounds pretty straightforward. But why that specific split?
Well, it's about balancing risk and potential return. Stocks can be more volatile but typically offer higher returns, while bonds tend to be more stable. As you get closer to retirement, you might shift that to something like 50-50 or even 40-60ths to protect your assets.
Makes sense. Now, what about tax-advantaged accounts? I hear a lot about 401ks and IRAs.
Great question. Both are essential tools for retirement savings. With a 401k, you can contribute pre-tax dollars, which lowers your taxable income in the year you contribute. Plus, many employers offer matching contributions, which is essentially free money.
Oh, I love that. So it's like a win-win situation.
Exactly. Then there's the IRA, which can be traditional or Roth. With a traditional IRA, you get the tax benefit up front, whereas with a Roth IRA, you pay taxes now, but your withdrawals in retirement are tax-free.
So which one should someone choose?
It largely depends on your current tax bracket versus your expected tax bracket in retirement. If you think you'll be in a higher tax bracket later, a Roth IRA might be more beneficial.
Got it. And what about the 401k contribution limits?
For 2023, the limit is $22,500, and if you're over 50, there's a catch-up contribution of an additional $7,500. So you could contribute up to $30,000 if you qualify.
That's a significant amount. And I assume you're also suggesting folks consider diversifying their investments?
Definitely. Diversification helps reduce risk. You don't want all your eggs in one basket. For example, if you invest only in tech stocks and that sector takes a downturn, your portfolio could take a big hit.
So, spreading out investments across sectors, asset classes, and even geographies can help?
Exactly. And don't forget about alternative investments, like real estate. Real estate can provide rental income and appreciates over time, plus it can be a hedge against inflation.
That's a good point. And how does Social Security fit into this?
Social Security can play a crucial role in retirement income. The age at which you start taking benefits can significantly affect your monthly payment. If you can wait until age 70, you might get about 8% more per year than if you started at 62.
Wow, that's a big difference. So it's really about timing your benefits wisely.
Exactly. It's also good to factor in your life expectancy and health into that decision.
Right. Now, let's touch on withdrawal strategies. I've heard about the 4% rule. Can you explain that?
Sure. The 4% rule suggests that if you withdraw 4% of your retirement savings each year, you'll likely not run out of money for at least 30 years.
So if someone has $1 million nest egg, they could withdraw $40,000 a year?
Correct. But keep in mind that this is a guideline, not a hard and fast rule. Market volatility can impact your withdrawals, so it's essential to be flexible.
That makes sense. Are there other strategies besides the 4% rule?
Yes, there's the bucket strategy, where you create different buckets for short-term, medium-term, and long-term needs. For example, you might keep a year or two of expenses in cash for immediate needs, invest the medium-term bucket in bonds, and put the long-term bucket into stocks for growth.
I love that visual. It really helps clarify how to approach withdrawals.
And one more thing about taxes. It's crucial to strategize your withdrawals based on tax implications. For instance, withdrawing from a Roth IRA first can be beneficial because those funds are tax-free.
So you're minimizing the tax burden during retirement.
Exactly. And remember, required minimum distributions, or RMDs, come into play once you reach 72. You'll need to take a certain amount out of your tax-deferred accounts, which can affect your tax situation.
Wow, so that's something to keep an eye on.
For sure, and it's also important to consider tax loss harvesting and other tax-saving techniques, especially if you have taxable investment accounts.
I've heard of that. Can you explain how it works?
Tax loss harvesting is when you sell investments at a loss to offset capital gains taxes on other investments. This can help lower your overall tax bill, which is especially useful in retirement when you might be withdrawing from those accounts.
That's a smart strategy. So, it sounds like there are a lot of moving parts to consider in retirement planning.
Absolutely, and that's why having a comprehensive plan is so essential. It's about aligning your investments, withdrawals, and tax strategies to maximize your financial health in retirement.
And as we wrap this up, what are some common pitfalls people should watch out for in their estate planning journey?
Well, one of the biggest pitfalls is not updating your estate plan regularly. So, Emily, as we dive into common pitfalls in estate planning, one of the biggest mistakes I see is the sequence of returns risk.
Oh, absolutely. That's when retirees experience a market downturn early in their retirement, right?
Exactly. Picture this. You've saved diligently for years, and then suddenly the market takes a dive just as you're starting to withdraw funds.
That's got to be a gut punch.
It really is. I had a client, let's call him Tom, who retired in 2008. His portfolio was solid, but with the market crash, he had to withdraw from a depreciated investment. His savings took a huge hit, and it was tough to recover from that.
Wow, that's a harsh lesson. What could he have done differently?
Well, one strategy is to diversify the withdrawal sources. If you have a mix of accounts, like taxable, tax-deferred, and tax-free, you can be more strategic about where you pull money from, especially in a down market.
That's smart. It sounds like planning for those withdrawals is just as important as saving in the first place.
Exactly. And then there's the tax situation. I find that many folks ignore the tax implications when they start withdrawing from their retirement accounts.
Right. Like if they pull from a traditional IRA, they might not realize that's taxable income.
Yes! I had a couple, let's call them Sarah and Mike, who started taking withdrawals without really considering the tax impact. They ended up bumping themselves into a higher tax bracket.
Ouch. That must have hurt their budget.
It did. They had to adjust their spending drastically. Being proactive about tax-efficient withdrawals can save you a lot of money in the long run.
What are some strategies for that?
Well, one approach is to withdraw from taxable accounts first in the early years, preserving tax-deferred accounts for later when you might be in a lower tax bracket.
That's a solid strategy. I can see how thinking ahead can really pay off.
Definitely. Another pitfall is underestimating healthcare costs and longevity. People often think they'll be healthy in retirement, but that's not always the case.
Right, and healthcare costs can be astronomical.
Exactly. I had a client, let's call her Linda, who thought she'd be fine with her savings. But she didn't factor in her medical expenses, which skyrocketed when she developed a chronic condition.
That must have been a real wake-up call for her.
It was. She had to readjust her entire retirement plan. It's crucial to account for healthcare costs, especially as we live longer.
So how can someone prepare for that?
A good approach is to look into long-term care insurance or health savings accounts. Planning for those potential expenses can really make a difference.
Absolutely. And what about asset allocation?
That's another critical area. People sometimes have too much in cash or overly conservative investments, thinking they're being safe.
Yeah, but that can really hurt them in the long run, right?
Exactly. Take a client I had, let's call him Jim. He was so risk-averse that he kept most of his portfolio in cash. When inflation hit, his purchasing power eroded significantly.
That's such a tough lesson.
It really is. A balanced portfolio that aligns with your risk tolerance and time horizon is key.
Speaking of timing, I know claiming Social Security too early is another common mistake.
Yes, it's tempting to take those benefits as soon as you can, but delaying can result in a significantly higher monthly benefit.
Right? I've heard some people don't realize how much they lose by claiming early.
Exactly. I had a couple, let's say they're Mark and Julie, who claimed at 62. They thought it would be enough to cover their expenses, but they didn't consider how long they might live.
Wow, so they ended up with a reduced benefit for life?
Yes, and they were surprised when they had to dip into their savings much earlier than planned.
That's tough.
It is. If they had waited just a few years, they could have made a much bigger difference in their monthly cash flow.
So it sounds like there are a lot of moving parts to consider with retirement planning.
Absolutely. That's why it's important to have a comprehensive plan that addresses these pitfalls.
And how can folks spot these red flags early?
Good question. Regularly reviewing your financial situation is key. If you notice you're relying heavily on your savings too soon, or if your asset allocation doesn't match your goals, those are red flags.
That makes sense.
Also, if your healthcare costs start rising and you haven't planned for them, that's a sign to revisit your strategy.
So proactive planning and regular check-ins can really help avoid these pitfalls.
Exactly. And seeking advice from a financial planner can provide valuable insights and keep you on track.
So what would be the next steps for someone who's recognized these issues in their own planning?
First, take a deep breath and reassess your financial plan. Identify where you might be falling short and make adjustments.
And maybe consult with a professional, right?
Yes, having a second set of eyes can really help clarify things and offer new perspectives.
I love that. It's all about being informed and proactive.
Exactly. Taking control now can lead to a much more secure and enjoyable retirement down the line.
That's such a reassuring message, David. Thank you for sharing these insights today.
My pleasure, Emily. It's always great to help people navigate these important topics.
Absolutely. And for our listeners, remember that planning is a journey, not a destination. There's always time to adjust and improve your strategy.
Right. So let's keep that conversation going and ensure you're set up for success in your retirement journey.
Definitely. And we'll be back next time with more tips and insights to help you along the way.
Looking forward to it. So let's dive right into some actionable steps people can take today, Emily.
Absolutely, David. You know, it can feel overwhelming at first, but breaking it down into smaller pieces makes it so much more manageable.
Right. One of the first things I recommend is to create a checklist. You can start by listing essential documents like your will, trust, and any powers of attorney.
That's a good point. Having everything in one place really helps. What about resources people can use to get started?
Well, there are some fantastic online tools out there. For instance, Vanguard, Fidelity, and Schwab all have retirement calculators that can help you project your future needs and see if you're on track.
Oh, that's so useful. And I think those calculators can also give some insights into your investment allocations, right?
Exactly. You can input your current savings and desired retirement age, and they'll help you see if your savings are aligned with your goals. Plus, they often provide a risk assessment to help you understand your investment style.
And if someone is looking for more personalized advice, using a financial planning app could be a great idea too.
Yes, apps like Mint or Personal Capital not only track your spending, but also help you visualize your retirement goals. It's a good way to stay accountable.
What about something a bit more traditional, like books or podcasts? Any recommendations?
For sure. The Total Money Makeover by Dave Ramsey is a classic, and I think it really lays out actionable steps for anyone starting out.
Oh, I love that one. And for podcasts, I'd say The Retirement Show has some great insights and interviews with experts in the field.
Absolutely, and there's also The Money Guy Show, which covers a variety of financial topics, including retirement planning.
That's a great way to stay informed while you're on the go. Now, what about some small habits people can start today?
One habit I really encourage is to review your portfolio quarterly. It doesn't have to be an intense process, just a quick glance to see if you're still aligned with your goals.
I like that. Even just setting a reminder on your calendar can make a big difference.
Exactly. And another simple step is to run retirement projections annually, just to see if you're still on track or if adjustments are needed.
Right, and it's never too late to improve your plan. Even if you're nearing retirement, small changes can lead to significant benefits over time.
Definitely. And don't forget about the Social Security Administration's website, ssa.gov. It offers tools to estimate your benefits, which is crucial for planning.
It really is. Plus, you can create an account there to keep track of your earnings history, which is super helpful.
And for tax planning, don't overlook tax software. Programs like TurboTax can help you better understand the tax implications of your retirement accounts.
And they often have features to help you plan for future tax scenarios, right?
Exactly. It's all about being proactive and informed. Even reviewing your tax situation once a year can lead to better decisions down the road.
So much to think about. You know, it might seem like a lot, but taking these small steps can really build up over time.
Yes, and it's important to remember that everyone's journey is different. What works for one person might not work for another, so be flexible with your approach.
Right, and it's great to adapt as your life circumstances change. Whether it's a new job, a change in health, or family dynamics, being open to adjustments is key.
Absolutely. And as you start to implement these steps, keep in mind that you're building a foundation for your future. Every little bit counts.
I love that perspective. So with these tools in your pocket, you're ready to strengthen your retirement plan. There's so much more to explore.
So as we wrap up today, let's quickly recap some of the key points from our discussion on the estate planning checklist for beginners.
Yeah, definitely. First off, we talked about the importance of having a will, right? It's kind of the foundation of any estate plan, making sure your wishes are clear and your loved ones are taken care of.
Exactly. And then we mentioned the role of trusts, which can really help in managing your assets and potentially avoid probate. That can save your family a lot of time and money in the long run.
Oh, and don't forget about designating beneficiaries. That's crucial too. It ensures that your assets go directly to the people you want without any unnecessary delays.
Right, and we also highlighted the significance of healthcare directives and power of attorney, making sure someone you trust can make decisions on your behalf if you're unable to, that can really give you peace of mind.
Such an essential part of the process, for sure. And let's not overlook the need to regularly review and update your estate plan. Life changes, and so should your plan.
Absolutely, staying proactive is key. It's all about building and protecting your retirement wealth so you can enjoy your golden years without unnecessary stress.
Well said, David. And for our listeners, if you found this episode helpful, please take a moment to like and subscribe. We'd love to hear from you. Comment with your biggest takeaway or any questions you might have, and share this episode with someone who's planning for or already in retirement.
Yes, please do. And remember, next time we'll be diving into how to estimate your retirement expenses, something that's vital for planning effectively.
Can't wait for that. Thanks for joining us today, everyone.
Until next time, take care and keep building that retirement wealth.
Bye for now.